Hello, welcome everyone. Good afternoon to those on the East Coast and good morning to those on the West Coast. Thank you very much for taking time out of your busy days to join us at One America and learn more about chronic illness and long-term care options. My name is Carlin Snipes and I'm the Regional Sales Director, and I'll be walking you through the webinar today. If you have any questions as we're going through, please in the chat box on your screen, go ahead and type in that notice, and I'll be watching that and try to stop and answer the question as you ask it during the presentation. And with that, we'll just get started looking at chronic illness and long-term care life insurance options. So the first thing we're going to click on, if I can get the page to turn, is our disclosures. I'm going to give you a second to take a look at those. And I'm going to go on to the next page, which is some more disclosures. And as I'm sure you've all had time to read it, we're going to go on to the next slide. So what I want to talk about today with you is 7702B policies or riders versus 101G policies or riders. And it's something that's very interesting to me because when I first started in this business and I started having exposure to chronic illness riders versus long-term care tax qualified riders, there seemed to be a lot of confusion about what one did and what one didn't do, or vice versa. So what we're going to spend time today is just clarifying the differences between these two types of policies. And with the aging of America, what we've seen is more and more need for long-term care out there. And in the past, people primarily were looking to traditional long-term care insurance policies to fulfill this need. There was a lot of changes in the long-term care industry, and you've all experienced it or lived it with the rate increases and people dropping out of the marketplaces. So there's been a lot of ups and downs with traditional long-term care insurance. So what you've seen in recent years is the increase in these chronic illness types riders as well as tax-qualified long-term care riders, which is a good thing because what it's done is given increased options out there to the public for different ways they can fund their long-term care needs. So I'm sure you've seen a growing number of these types of products, and typically what you're going to see is these riders are typically you're going to see them added onto either a life insurance policy or maybe even an annuity policy. So you have a different chassis depending on how you want to use it and how it wants to look. I actually did a presentation several years ago talking about the differences between these two types of riders, and I saw a producer in the back lean over and ask his upline. He said, well, what type of policy am I selling? So he really didn't have any idea if he was selling the 7702 version or if he was selling the 101G version. So he didn't know if it was tax qualified long-term care or if it was just a chronic illness rider. So some of these things, what it's helped is the common objection you've heard maybe in the past from your clients related to use it or lose it, because what these policies enable the client to do is get long-term care protection. But if they don't need it, they never needed that policy for long-term care, there's still a benefit to these policies with these types of riders. Unlike traditional long-term care where you're paying that premium, and if you never needed it for long-term care, then potentially there's no benefit out of that traditional long-term care policy. It's just they put money into it. They never needed it for long-term care, so if they don't use it, they lose it. So these types of policies really overcome that objection because either you're going to get a death benefit with these types of policies or there's going to be an annuity value with these types of policies. There's also something I'm going to highlight today, especially when you're thinking about One America. Some of these policies, and ours does, it fits into this boat, have guaranteed long-term care premiums. And what I mean by that, if you're looking at one of our policies and it's an annually paid policy, you have the ability to guarantee that premium. So you know from day one what that premium is going to look like, and in day 30 in the policy, year 30 in the policy, that premium is going to be the same because our policies are on a whole life chassis. If you're looking at the life insurance side, and those policies are non-cancelable policies, so we can never step in and change that premium. Unlike traditional long-term care where you've seen rate increases happening on that side of the house. So they're two very different approaches. They may seem similar when you're thinking about a 101G policy, a chronic illness policy, or when you're thinking about a 7702B policy. But there are some differences, and I want to highlight those with you today just to give a better understanding of what we're looking at. When you're thinking about chronic illness, it's very interesting the way they phrase it. And you'll see in the top bullet, they've got a little verbiage there about how it's kind of phrased in a chronic illness rider, to how they determine what type of claims qualify for benefits, how those benefits are paid, and how the applicable costs are applied. It's, like I said, it's very important that you understand the difference, because you don't want to have an agent, or you being the agent on a policy, sell a policy, think it's traditional, it's a tax qualified long-term care rider, and find out it's chronic illness, because there are some differences that you want to be aware of. So when you're looking at life insurance with an accelerated death benefit for chronic illness riders, that is a 101G type of policy or rider. If you're looking at a life policy with long-term care benefits, you're looking at a 7702B. And these are just sections of the tax code is what I'm referring to with 101G and 7702B. So what you're looking at, typically what you're talking about there, is asset-based long-term care. So there's some benefit beyond the long-term care benefit the client's going to get out of the policy. So let's look at 101G first. Let's start there. So accelerated death benefit for chronic illness riders, what does that mean? What are we looking at when we're talking about 101G? And typically what it is an amount received, and it's right there in the bullet point, an amount received under a life insurance contract on the life of an insured who's chronically ill, and shall be treated, this is a key, I like this section, shall be treated as an amount paid by reason of death of the insured. So that's how the wording typically is when you're looking at a chronic illness rider or 101G. And if you've heard in the past when people talk about chronic illness riders, you might hear about, at the bottom of the page, there's these two advantages to 101G types of policies. One of them is bill administration, you might hear about that, and the second might be the ability to pay family members. So I want to really talk about that, because when you're looking at these 101G riders, typically these policies are paid on an indemnity basis versus a reimbursement basis, and we'll talk about that a little bit more. But when it's paid on an indemnity basis, what's happening is the insurance provider is cutting a check to the client, and then the client is using that money as they need for that, either the long-term care issue, that chronic illness issue, or what have you. So instead of them having to set it up that the insurance carrier pay a facility for their care, they're the ones taking care of that check, which could be a good and a bad thing depending on the way you look at it, because what happens is, depending on how large of a check that's being cut, it's going to have to clear their bank. There's a couple of days there, depending on the bank, you know, the size of the check. It's going to have to clear their bank. Then they're going to have to write another check to the provider. So there's some steps they're going to have to take, even if it was an indemnity. Whereas if it's a reimbursement type of rider, it could be set up to the facility, or the care provider, if it's a home health care provider, could be set up to receive the payments directly for the care that they're receiving. The other thing you'll hear as an advantage when people are talking about indemnity-based policies is the ability these policies provide that they can pay family members for their care. And again, I think this is a double-edged sword, because more than likely family members are going to step up and help their family. Either parents, let's say it's a sibling, they're going to step up and help mom and dad should they need assistance. But what will happen if you're paying them, then you're going to have one, maybe the adult daughter, the oldest adult daughter being the one that's taking the brunt of the support to mom and dad, and that could cause resentments. Also, it opens up some ability where the money's not used appropriately, so the money that's supposed to be there to take care of mom and dad is not being used to take care of mom and dad. So there's just a couple of things when you think about these advantages, they might not necessarily be advantages when you're looking at indemnity type policies. So now let's look at what I mean about life insurance with long-term care benefits, or 7702B policies. What does that look like? So these are just simply life insurance products with long-term care benefits and or riders that fall under the tax code of 7702B, and they typically, and I will say typically, offer more comprehensive coverage than you're going to get out of a chronic illness rider or a 101G. They usually pay benefits on a reimbursement basis, and there might be some out there that don't, but typically if you're seeing a policy that's on a reimbursement basis, more than likely it's a 7702B type of rider. It's not going to be a 101G, but there are some differences out there. For OneAmerica, all versions of our asset care policies are 7702B long-term care policies. So they qualify under the tax code of 7702B. So the things that we're going to hit on today and the time that we have together are just the typical differences when you're talking about 101G plans and 7702B plans. So I'm going to start off touching on marketing guidelines. We're going to look at access to death benefit. We're going to talk about temporary and permanent conditions, which I think could be easily overlooked, but I really want to spend some time there. Obviously, I want to talk about the tax treatment of the benefits, what that looks like. We're going to talk about continuation of benefits riders that are available, and we're going to wrap up with claims qualifications. So with that, I want to start out talking about the differences between these two types of policies. We're talking about marketing guidelines. So with 101G, the key to remember, and one way to help you tell if it's a 101G policy, is it cannot be marketed or it cannot be labeled as long-term care in marketing or in any sales literature. It's never going to be called long-term care. Now, it could definitely be called chronic illness, but it's not going to be called long-term care. So that's one way you can look at one of these riders and tell, okay, it's not going to be tax qualified under the code 7702B because it can't be called long-term care insurance. So that's one thing you want to keep in mind. Again, if you're looking at a 7702B policy, it definitely can be marketed as long-term care, and it will be marketed that way. So that's one way to tell the difference between these two types of policies. On this page, I want to highlight just really quickly, these are just some examples of common 101G rider names, and they're really interesting if you look at them. I like the first one, Accelerated Access Solution. So, I mean, to me, that sounds like that rider will do anything and everything that I could possibly need. You'll see some others, Extend Care, Accelerated Death Benefit for Chronic Illness, Enhanced Care Benefit. The theme of all these names is not one of these names says long-term care. So you can know if it doesn't have long-term care in the name of the rider. That's one key to it being a chronic illness rider and not a 7702B tax qualified long-term care policy. This is just an example of two riders, and it just pulls out the definitions. So if you're looking at potentially the illustration or the contract, and it's defining the rider and the wording, and I'm just going to highlight a couple of things in these two examples. The first example is called an Accelerated Death Benefit Plus rider. So again, no mention of long-term care, but it does tell you what it's going to do is advance a portion of the death benefit in the event of specified medical conditions or permanent confinement to a nursing home or terminal illness. This rider is exercised, their interest charges will be assessed. Now, it doesn't tell you what that's going to look like. It just tells you that interest charges will be assessed, but you're not sure what that's going to be. Other charges may apply, so there's some additional charges. Again, they're not really defined what those charges are going to look like. But this rider will automatically be included in your policy. So now let's look at the other example. So Accelerated Death Benefit Life Plus rider. And really the only difference in the name of these two policies or these two riders is the life. On the first one, life wasn't included. And it's very similar wording. It's going to advance a portion of the death benefit for terminal illness, for specified medical conditions, or chronic illness. If they go on to actually define what chronic illness is in their rider, which is being unable to perform 2 of the 6 ADLs for at least 90 days. But again, they highlight, if the rider is exercised, interest charges will be assessed and other charges may also apply. So they do clearly tell you, again, there's a charge to this rider. Because what I've heard a lot of times when people are looking at chronic illness riders is they're like, well, I can get this policy with a chronic illness rider. It's not going to cost me anything. And that's true. So there are policies out there like there where it's not going to cost you anything. But really, is there any free rides? So, and what I mean by that, it's not going to cost them anything up front. But where the cost comes into play is when they actually exercise that rider for a long-term care benefit, and I say long-term care benefit, for a chronic illness benefit, not to confuse the issue. So when they go to use it for that chronic illness need, that's when they're going to find out what the cost is going to be to them for that rider. So again, just 2 quick examples of language for 101G riders. So that's the end of the marketing guidelines. Just one way for you to tell is 101G, they're not supposed to be marketed as long-term care. And then the 7702B, they can be marketed as long-term care. So with that, let's talk about the access to the death benefit and what that looks like between these 2 types of policies. So let's look first at 101G. How do we access a 101G policy? And I kind of alluded to this in the earlier slide. These riders can be paid for with an internal cost of insurance charge, or may be available at no charge. And then it goes on. So you stop there at no charge. A lot of people would stop right there. Well, it's no charge, but then it says, in conjunction with a discounted acceleration of death benefit, also known as actuarial discounting. So another way for you to determine if the policy is a chronic illness rider or a 7702B type of policy, call the insurance carrier who has that policy and ask them what the long-term care benefit is. They will not be able to tell you what the long-term care benefit is because that benefit is not determined until time of claim, and that's when the actuarial discount is applied at time of claim. And there's a couple of factors that come into play when they calculate it, and as you can see in the bottom bullet on the screen, they use factors such as age. So the age the client is at the time of claim, not the age they were when they purchased the policy, but the age they are at the time of claim. Gender, which would be the same regardless of, typically would be the same regardless. So if they were a male when they bought it, more than likely they're going to be a male when they go on claim. Also, interest rate determine what portion of death benefit will be available. So what happens with the interest rates is going to come into play, if they're going to go down or if they're going to go up. And who knows what's going to happen with interest rates. They've been down for a very, very, very long time. But these things are going to be the factors that are going to help determine what that benefit's going to look like at the time of claim. The one thing I wish they would include on the slide that's not out there, and I think this is going to become a major factor on chronic illness riders in the future, is claims history. So what's that carrier's claim history has looked like in the past? That's going to have an effect on what factors they're going to use to calculate that benefit for that chronic illness. I definitely think that's going to have an effect in the future. I'm going to check really quick and make sure no one has asked any questions. I don't want to miss anything. Okay, no questions, good. So let's look at an example, and this is just a hypothetical example, but what we want to do, I want to show you a 7702 plan, 7702B versus a 101G. So a tax qualified long-term care rider up against a chronic illness rider and what that looks like. So what you see here is two policies, and I think I see a hand raised, so I don't want to miss that. Okay. Bruce, did you have a question? If you want to type it into the chat box, I'll be glad to answer your question. I might be able to take you off mute if you want to. Yes, Bruce, I took you off mute, so if you have a question and you want to read it out to me, I'll be glad to help you. And I'll leave you off of mute for a little bit until you can get over to me. So let's look at a long-term care policy rider versus a long-term care tax qualified rider versus a chronic illness and what that looks like. So what we have here is two policies. Both policies provide a death benefit of $300,000. So if they were to pass away and never needed it for a long-term care issue, they'd get $300,000 with the tax qualified plan. They'd get $300,000 with the chronic illness rider. So that's the same. Look at the maximum benefit payout, the second row on this page. So for the long-term care benefit, it would be 2% per month. So they're going to take 2% of that death benefit, and that's going to be the long-term care payout that the client will receive. And then if you go over to the chronic illness rider, the way that it is worded is very special. So what it says is, we're going to give you 24% of the death benefit. So I'll skip over that present value for a moment. So if you look at 24% of the death benefit and 2% of the per month of value, if you were to calculate that out, it would probably both of them look like $6,000. But the key on this one is the present value piece. So what the present value of that 24% of death benefit is going to look like. That's important. That's the actuarial discounting being applied to the policy. So now let's look in year one and see what the benefits are. So in year one on the tax qualified option, we're going to pay out, if they were to go on claim, a maximum of $72,000. And that's going to reduce the death benefit proportionally. So from $300,000, the death benefit is going to drop to $228,000. This is where the big difference comes in. So you go over to year one on the chronic illness option, what you're going to see is the present value of 24% of the death benefit is actually going to be calculated, and it's going to come out to be a $36,000 benefit for chronic illness. But what's interesting is that even though they're only paying out $36,000 in benefit, they're going to reduce that death benefit to $228,000. So it's going to have a major impact on how long that money is going to last, because we're putting in that actuarial discount. And as you can see in year two and year three, you're going to see the same things happening where that death benefit is going to be going down on the tax qualified side proportionally. Unfortunately, on the chronic illness side, it's going to have that extra calculation in play, and it's going to cost them more to get that benefit. So that's what I was talking about earlier, is it may seem like it's not a cost to add a chronic illness rider in the front end. The cost the client's going to see is on the back end when they actually go on claim. That's when they're going to see what the actual cost is going to look like. So let's go on to the next slide. So continuing on with the theme about the ways you access the death benefit. So we've touched on how you access the death benefit for a 101G policy. So now let's talk about for a 7702B policy. And these policies typically will give you access to 100% of the death benefit for long-term care. So what they're meaning is, back to my earlier example that we just walked through, it was a $72,000 benefit that they would give, but they would actually give the client access to that whole $300,000 up to the maximum they'll offer for a monthly amount. So in that example, the monthly amount maximum was $6,000. So they can't access the money any faster than that, but as long as they need it for long-term care, they can access it up to $300,000 and get the full access to the death benefit. And again, as I mentioned earlier, these benefits are determined up front at the time of issue. So if you were to call a carrier that's selling one of these 7702B types of riders, they can tell you, if you call them, they can tell you today what that long-term care benefit is going to look like. Unlike the chronic illness, which cannot tell you because it depends on when they go on claim as to how that calculation is going to work. So this is a significant difference between chronic illness riders and tax-qualified long-term care riders. So just make sure you're aware of the difference. You know, I'm not saying one's better than the other, but you just need to know the differences, because maybe you've got a client that could not qualify for a tax-qualified long-term care. They couldn't get through the underwriting, and this would be their only option. A chronic illness might be their only option to get some types of long-term care protection. That might be the best way for them to go. But if they can qualify for underwriting, then they'll get more benefit out of the 7702B plan than out of the 101G chronic illness rider. So that's just a key to keep that in the back of your mind. So with that, let's talk about temporary versus permanent conditions and what that looks like. And I really like this section a lot. I think this is really good information to know. So when you're looking at these types of products, so when you're looking at chronic illnesses, the way you qualify for a claim, typically a licensed healthcare provider must certify a chronic illness, which that's pretty consistent across the policies out there. The key with chronic illnesses, most of the riders have verbiage that says basically whatever that illness is, it must be likely to last the rest of the insured's life, i.e. it must likely be a permanent condition. So that's one thing to keep in the back of your mind. So with most 101G plans, they're looking for a permanent condition to pay to go on claim. When you're looking at a 7702 policy, the language is a little bit different, and so they're going to again ask for that licensed healthcare provider to certify that the insured for a period of at least 90 days is unable to perform 2 activities of daily living or is cognitively impaired. So if they can't do 2 of the ADLs, or maybe they're experiencing, maybe they have dementia, they would qualify for coverage under the 7702B plan. Now, what's interesting here, and a lot of people don't think about this, there might be a situation, somebody fairly young, let's say, buys one of these policies. Maybe they're in their 50s, maybe in their mid-50s. Let's say somebody 55 buys a policy, and him and his wife have a policy. And let's say they're driving down the road and have a horrible, horrible car accident. And the accident was so bad that they could not, let's say the husband, could not do 2 activities of daily living for 90 days or more. But he was likely to recover from this. The 101G policy would not provide coverage to him, but the 7702B plan would. And this comes into effect too for things like cancer. There's people that maybe go on claim with some type of cancer situations, and then they start to get better and they recover from it. They go off of claim, and then maybe a couple years down the road they go back on claim. So the thing with things like that, they're not permanent illnesses, but they are something that we will cover under a 7702B plan. A 101G will not until it's certified that that illness, most 101Gs, will not until it's certified that that illness is going to be a permanent condition. So some things to think about. Obviously, if you're looking at something like a cognitive impairment, so someone that has Alzheimer's or dementia, they're diagnosed with that, or ALS or Parkinson, the 101G policy will be pretty much the same way well, that will be considered a permanent condition, and they're going to cover that, just like the 7702B plan will. So that when it's a permanent condition, they're pretty consistent. This is where you're going to see some of the differences when you're looking at a temporary situation. And one of the things I want to highlight is strokes. So one of the stats that we have related to strokes is only 25% of stroke victims die shortly after the stroke or need permanent care. So only 25% of the folks that experience a stroke would qualify for coverage under a 101G policy. So here's some more stats for you when it comes to stroke victims. So 10% of stroke victims recover almost immediately, so almost completely, excuse me. So those folks that maybe couldn't do 2 activities of daily living for 90 days or more, they would qualify under our 7702B plan, but they wouldn't qualify under the chronic illness rider. And then another 25% do recover with maybe some minor impairments. Again, they would not be covered by the 101G plan. 40% experience moderate to severe impairments that require some care. And that doesn't mean they require assistance with 2 activities of daily living. So again, you're looking at 10 plus 25 plus 40. So you're looking at 35, 75% of folks that might, they would not qualify. 75% of stroke victims that would not qualify under the 101G plan, but would qualify for assistance or coverage under the 7702B plan. So that's just something to think about, because not every condition that a client might experience is going to be a permanent condition. And I already mentioned this earlier. What about injuries sustained for a result of an accident? That was my car accident, but there's another example, and the stat in the middle of the page, people 75 and older who fall are 4 to 5 times more likely than ages 65 to 74 to be admitted into a long-term care facility for a year or longer. So they could fall, but they still potentially will recover from that fall. So again, they wouldn't qualify for coverage under a 101G plan that requires a permanent condition to qualify. So we've touched on marketing guidelines. We know that you can market a 7702B plan as long-term care, but you cannot market a chronic illness. We've looked at the access to death benefit and the differences there. Primarily, you're talking about the actuarial discounting method on the chronic illness. And then we've covered temporary versus permanent conditions. So we're about halfway through. The thing you need to know with temporary and permanent, as we've discussed, is some 101G plans require it to be a permanent condition. So with that, let's look at the tax treatment of the benefits between these 2 types of policies. So let's start with the tax treatment of a 7702B plan. And hold on a second, I do see some hands raised. So let me see what the questions are. I might have missed a few here. So let's see. First question from Bruce. After you recover, outline, please discuss the differences in underwriting. And the differences in underwriting when you're looking at a chronic illness rider as well versus a long-term care tax qualified rider. So most chronic illness riders do not require underwriting. So the client can add that rider to that life insurance policy without any long-term care underwriting to qualify. So that's why a lot of people might look at that plan, because maybe they couldn't qualify for a long-term care policy. So they're looking at a chronic illness rider because that's all that's available to them. Now, if you're looking at a 7702 rider, typically what you're going to be looking at is underwriting for morbidity. So they're going to look at the client and make sure they qualify from a long-term care standpoint. So they're going to underwrite that person from a long-term care standpoint. And then we have a question from Dennis. What is the optimal age for applying for a 7702B product, and how stringent is the underwriting? So it depends on the client. It depends on how they want to pay for it. What we've seen on our policies, our single premium policies have a higher issue age, which is right around, in the mid-60s, so 64, 65. But if you're looking at one of our multi-pay products, you're looking at a younger issue ages, so people are buying those policies at age 55. The younger, the better. If they can afford to buy these policies because their insurability is going to be better, the younger they are, and it's going to be cheaper. So the younger they can get into these policies, the more attractive they're going to be. The underwriting will vary depending on which company that you're looking at. One America has a lot of advantages, especially if you ever take a look at our height and weight chart. I don't think you have anybody that wouldn't qualify from an underwriting standpoint, but we can give you underwriting guides that can give you some information. There's probably, I don't know, about 50 or so common impairments you can look up and see, okay, based on this impairment, would OneAmerica consider them? And most companies that offer a 7702B will give you that type of guidance on the underwriting standpoint. We also offer what I call a quick quote underwriting box. So if you have a situation you're not sure about if they would qualify, you can always shoot that information over to our underwriters. They'll review it for you and let you know if we would consider that client for our asset care policy. So let's see, we have another question from Lewis. My understanding is that recent 101G riders must cover chronic illness in the same way as long-term care riders, as long as they are certified in the last 90 days. No permanent condition, no permanent requirement. True. There are some new, Lewis, there are some newer 101Gs that don't have that permanent condition language. Really what you need to do is just look at the contract language and how it's worded. Some of the older ones definitely have that permanent condition, so it varies. Not all chronic illness require it to be a permanent condition, but some do. So that's the main thing. You just need to take a look at the contract and make sure. Just ask the carrier how they handle it. Okay, with that, we'll go back to the presentation. I think I've got all the questions that we just had. I'll make sure we don't have any hands raised, and I think both the hands were Dennis and Bruce, and we took care of their questions, so we're good right now. All right, so let's talk about the tax treatment. So when we're looking at the tax treatment of 7702B plans, how is that handled? So long-term care benefits that are paid under this section of the code are generally treated as excludable accident and health insurance benefits under Code Section 104A3. And if you're really bored and you're having trouble sleeping one night, go ahead and take a look at the section of the code late at night and start reading it, and you'll see Section Code 104A3 refers you back to 7702B, and it does say that basically they are excludable and therefore income tax-free benefits. So if someone were to buy a policy that has a 7702B benefit rider into it, the benefits they're receiving, the long-term care benefits they're receiving out of the rider, are income tax-free to the client. So now let's compare that to the differences of the tax treatment of a chronic illness rider, or 101G. So these benefits are typically an acceleration of the death benefit under the Code Section 101G and are generally excludable from income like death benefits. So that's good. Now this is the thing you need to keep in the back of your mind. However, they may be taxable based on the per diem limits. So in 2016, the per diem limit was $340 a day. So what you'd have to look at is, that client and their situation, and you multiply 340, by 30 days and get that per diem limit for that month, and then multiply it by 12, and you can get the per diem limit for the year. There are some changes to the per diem limit. Obviously, it changes and it fluctuates. It looks to me like from year to year, it's usually only $10 more, or it remains flat. And actually in 2014 and 2015 there was no change. The per diem limit stayed the same. So the thing to keep in mind, and I'm not a tax consultant, so I don't want to give you tax advice, and the compliance people wouldn't like me doing that, but just keep in the back of your mind the tax treatment will depend on a number of factors, and the policy owner should consult their CPA regarding the tax treatment of the benefits. And I see a question, so let's jump over here really quick. So the question is from Bruce, 7702 benefits not taxable if clients paid with the corp. Same for 101G. I can give you a tax guideline and I can give you more information. It depends on how it's set up, Bruce, so we can give you some more. We do have a tax guide that we can share that gives you some common information related to that, so I'll be glad to share that at the end. And then Dennis, can you provide illustration with benefits after 10 years? So what you're asking, I want to make sure I'm understanding, Dennis. So can you illustrate a 7702 plan with showing what the long-term care benefits would be after 10 years? If I'm understanding you correctly, then yes, you can definitely see that on our illustrations. And I think Ty asked a question. After you cover all the time, please discuss. Oh, I answered that one. Okay. So Dennis, if I'm not understanding your question correctly, please ask it again. Just please let me know. So look, continuing looking at the tax treatment on 101G policies, and I'm trying to slide my little questions box out of the way so I can see. Okay. So many 101G policies may not have benefits in excess of the per diem limit. So what I mean by that is what they'll do is they'll set those policies up so they'll never pay out more benefits than what the per diem limits are. So that way the client never has to worry that they've exceeded the per diem limit. That's one way to look at it. But it also limits that policy to that specific amount. And if the policy allows for distributions in excess of the per diem limits, that's where you're looking at potentially some significant tax consequences that must be addressed to the client or must be explained to the client. So I'll give you an example here. So what we're looking at, this is a 101G plan, and this particular plan actually paid the client a lump sum. So if she were to go on claim, and I think she was, I want to say she was 65 when she purchased this policy, and they were showing her how the policy worked and what would happen when she went on claim and how she could access the death benefit. So what you're going to see here is, let's assume she went on claim at age 85, which was year 23 of the policy. What it shows you here, and you see that little call-out box, I've actually squared it off there, under the chronic illness max lump sum advance amount. What this is showing to Mrs. Client is if she were to go on claim at age 85, she could accelerate that death benefit on this policy up to just shy of $857,000. So she could access, you know, in that year she went on claim, they could cut her a check for $857,000. Well, that sounds wonderful, and that's like a lot of money. She can get a lot of money in 1 year. But the thing to keep in mind, let's go back to that $340 a day, and we'll multiply $340 a day times 30. So the monthly amount, the maximum per diem, is $10,200, and let's multiply that by 12. So for the annual amount, so the the annual amount under the per diem requirements in 2016 are $122,400. So if we subtract this $856,698 that they're going to pay her, she's exceeding the per diem limits by just over $734,000, which could potentially cause a huge problem for her from a tax standpoint. Now, obviously, the per diem limits are $340 today, and we won't know what they're going to be, you know, 24 years down the road. But you can see in the past that they don't grow substantially. They're growing they're either staying flat or they're going up $10, you know, a year. So they're not going to dramatically jump up. So a problem with a policy like this is they are going to pay her this $856,000, but she's potentially going to have a tax situation because she's getting a lump sum advancement and so much of excess of what those per diem limits are. So just something to think about and make sure that you're aware of with these types of policies. So we've touched on tax treatment of benefits, and I'll definitely get you that tax treatment guide. I do think it's a really good guide. It gives you a lot of good information. But let's move on to continuation of benefits rider, and let's talk about that and how that works. So what do I mean by continuation of benefits rider? So what most chronic illness riders will allow is the insureds to access a percentage of the policy's death benefit per month. And this can vary. It could be 1%, it could be 2%, it could be 3%. Usually it's between 1 and 4%. That's what they're going to allow the client to access of the death benefit on a monthly basis to cover their long-term care needs. Now, depending on the policy, it could be up to the full face amount, or it could be a percentage of the full face amount or a fraction of the full face amount. That just depends. Well, unfortunately, when you have something like that happening, what's happening is you're really limiting the amount of coverage that the client can get out of that policy. So that's one thing to think about when you're thinking about continuation of benefits riders. When you look at 7702B policies, and especially if you're looking at One America's asset care policies, they offer you the option to purchase additional long-term care benefits above and beyond the death benefit. So if you're looking at a chronic illness rider, let's say, and the death benefit was $300,000, depending on the way they calculate it, they could get a percentage of that $300,000, and maybe they could get all of that $300,000 for long-term care. But once they exhaust that $300,000, that's the end of the policy, and there's no more benefits available. With a policy like asset care, you can add a rider to the policy that will actually extend that pool of money for long-term care. And what I mean by that is they'll get that $300,000 death benefit, but on top of that, they can add a rider, and it could be a lifetime rider that's available for long-term care as long as they need it for long-term care. It'll be out there and available. So on asset care, this feature is called the continuation of benefits rider, and it's very, very attractive. And from a cost standpoint, it's not dramatically more for them to do, and it extends that coverage. And I think it's extremely important when you're thinking about long-term care, because a lot of people want to look at what's the average length of claim, and a lot of policies sold today, you know, and they might be a 4-year benefit, they might be a 6-year benefit. So there's multiple things going on when you're looking at these benefits. But the one thing that I want to bring out to you is, let's say the average length of claim for a man is approximately 2.7 years. And I'm sure you've heard that. And the average length of a claim is for a lady, it's actually 2.2 years, I'm sorry. For a lady, it's 3.7 years. But the thing you need to think about, what's the average length of a claim for an Alzheimer's patient? Well, that's 8 years. So that's twice as much. If it's a 4-year benefit, that Alzheimer's claim could last twice as long as that policy will provide benefits. So we'll talk a little bit more about averages as we go through this presentation, but it's something to think in the back of your mind that a lifetime benefit will cover that client for as long as they need it for long-term care. I want to make sure I see a hand raised. I want to make sure I'm not missing anybody. Okay, I think everybody's okay. I think it's just earlier. So going into that continuation of benefits rider a little bit more. So Asset Care is a unique product in the linked benefit space, or the asset-based space, because we're the only policy available today that offers optional lifetime benefits. The client can purchase a lifetime protection for long-term care. So the question underneath that is 50 months of coverage enough? And what I'll say to you is this: in my own personal family and my own history, when you're talking about long-term care, my husband's grandfather was a farmer. Extremely vital man. I mean, he was just vibrant. He was just a very vivacious type of individual. He was just the life of a party. Well, unfortunately, he was diagnosed with Alzheimer's, and he needed care for 17 years with Alzheimer's. Physically, his body was perfect. I mean, he lived a very long life, but unfortunately, he had Alzheimer's for the last 17 years of it. So he needed care for 17 years. My grandmother needed care for 10 years. She had dementia, so she needed care for 10 years. And unfortunately, my dad, he needed it for 2 months. So when you're thinking about averages, they're all over the place. What you need to think about for your clients is, what does their family look like? What's their expectation? How they want to be covered? How do they want to be protected? Do they want to have that 10-year claim, and how are they going to fund that 10-year claim? And how is it going to impact their family from a physical standpoint, emotional standpoint, as well as a financial standpoint? Because there's multiple things to consider. Because the thing with long-term care is it does not pull families together. It actually tears families apart, because it's just, there's resentment for some people doing more work than the others, and some siblings are helping out more than the others. So there's a lot of things to think about with long-term care, but I really believe in these lifetime benefits, because if you purchase a policy like this, you're going to get a long-term care benefit out of the policy if you go on claim and you need it, regardless of how long you need it. You could be on claim like my husband's grandfather for 17 years, and you'll be covered for that 17-year period. So the problem with averages, and I really like this picture. I probably think this is probably my favorite slide in this presentation. So what you're seeing here is a bunch of, scatter plot, just a bunch of data points out on a grid. And if we were to draw a line through the middle of this, this would tell you the average of this data. But this line tells you absolutely nothing about this data. It doesn't give you any information. And the other thing, when you're talking about averages for long-term care, the average length of claim, I do not believe that calculation has taken into effect the number of years or months or time the clients are on claim where the family is taking care of them before they actually say, hey, I need help. So you need to take that in consideration, because people want to receive care in their home and they want to avoid these things, but unfortunately it happens. But those average lengths of claims, I think, are substantially longer than we think about. The other thing I want to touch on before I jump off of this slide when we're talking about averages, think about it this way. So let's say we lived in a subdivision where it had a golf course in the middle, and the houses obviously closer to the golf course were worth more than the houses further out in that subdivision. So let's say the houses at the golf course, they were all $1 million houses, but the houses further out were, $300,000 houses is what they were. So if their P&C guy comes to them and says to the guy that has the $1 million house, based on all the houses in the subdivision, the average cost of these houses are $500,000. So you need to get a $500,000 policy for your house. Would that make a lot of sense when his house is worth $1 million? No. So that's what I think it's interesting, because probably we're one of the few in the industry that we focus so much on these average lengths of claims, and it's not necessarily the best thing to do for you and your client. So with that, I'll jump off my soapbox and we'll go on to claims qualifications, and we'll wrap up with claims qualifications. So let's talk about claims qualifications. So if you're looking at a 7702B policy, these are standardized by law. So there's two ways for the client to qualify for claim under these types of policies. And we've touched on this throughout the presentation. One is being unable to perform at least 2 of the 6 activities of daily living. And 2 is they need care as a result of a cognitive impairment. So that's consistent when you're looking at 7702 plans. That's how they qualify with one of those types of plans. So when you're looking at 101G plans, there are some differences, and it's not consistent because it's not necessarily standardized like 7702 plans are. There are some similarities, but there's also some significant differences. And here's just a couple examples on this page of some of the wordings from some sample 101G policies that we pulled. If you look at the bottom bullet, confined to a nursing home for 6 months or terminally ill with a 6-month life expectancy. So that policy is not providing a heck of a lot of benefit to that client. The top one, requiring continuous confinement in a long-term care facility or under a written plan of home care and stay for the rest of their life. So the way these two examples are worded, it's very much a permanent condition they're looking for them to qualify for claim under that 101G policy. The elimination period typically on 7702B policies is generally 90 days. Some of them it can be shorter, but on average, let me throw that word out, on average, but typically it's about 90 days on most policies. On our asset care policy, we do have a 30-day elimination period for home health care and a 60-day elimination period for other services. And I do think it's important with that 30-day period because, like, as I said earlier, most people, when they want to go on, when they have to go on claim, they want to stay at their home as long as they possibly can. So this way they're going to be able to go on claim if they have to. They're going to start receiving the benefit out of their policy quicker if it's at a home care situation. So some claims qualification questions or some different things you'll see again. The elimination period on life insurance policies with chronic illness I mentioned was 90 days. But again, this can vary widely. The chronic illness, again, it's like 7702B policies, it's generally 90 days, but depending on the policy, and you can look at the contract and you can see the wording. If it's a chronic illness rider, it does not necessarily have to be a 90-day elimination period. And here you can see a couple of samples. One is 2 years, which I don't know, I mean, if you're looking at the average length of claim and it's only 2.2 years for a man, I don't know what benefit he would get out of that policy. The other is 12 months in a nursing home facility. And there's another one that's 6 months, nursing home usage only. So just look at the contract, make sure you understand what the elimination periods are, and there are a lot of differences depending on the policy. Just make sure you have a good understanding of that. The last couple of slides, I want to see how I'm doing on time here. So we've got about 13 minutes, because I want to make sure and respect your time and we wrap up on time. I like the last couple of sections, a couple of slides, because what we want to do is just do some comparisons of different type policies. So what I'm showing you here on the left-hand side is a 101G policy, which is a chronic illness rider, and I'm comparing it against our asset care policy. Now, on the 101G side, you're going to see 2 individual policies. There's a male age 65 in the first column there, and then there's a female age 65. On asset care, we have the ability, we have a patent on our joint and survivor option, so we have the ability to cover 2 individuals on one policy. So we don't have 2 deposits on our side. We only have 1. So it's a $200,000 premium going into our contract. It's a total of $200,000 going into those 2 individual contracts on the 101G side. So for the husband, we'll assume it's a husband and wife. The husband, it's about $221,000 in death benefit, and the wife is $268,000. So they're at 48, almost 49,000 in death benefit. On our policy, it's $246,000. So you have a smaller death benefit. But the thing I want to ask you is when a client is looking at these policies, what's their number one concern? Is their number one concern the death benefit, or is their number one concern the most long-term care benefit that they can get out of the policy? So that's going to come into play when you're looking at these policies. So if you go down a little bit in the middle of the screen where it's more bolded out, it's going to show you an example claim on both policies. So on the 101G policy, after 5 years, goes on claim. The maximum acceleration of the policy is 80%, so he can access $177,000 of his death benefit, but we need to apply that actuarial discount. In this example, we're using 4.5% a year, so that's almost $40,000 discount. So the maximum that he'll be available to accelerate is just shy of $140,000 of that original $221,000 death benefit. Now, if you look at the wife's policy, example claim in 7 years, again, she's got access to 80% of that death benefit, so it's $214,000. You need to apply that actuarial discount of $67,000, so the maximum that she'll be able to accelerate in this example is $146,000 for long-term care. And at the very bottom, you'll just see the cash surrender value. So in year 5, it's about $36,000 in both of the man's and the wife's policy, so a total of $73,000 if they were to change their mind in year 5. Now let's go over and look at the example claim for asset care. So in year 5, the husband were to go on claim, his monthly long-term care maximum benefit is going to be $7,400. If the wife were to go on claim in year 7, her maximum long-term care benefit is going to be $7,400. So when you're looking at one of the asset care illustrations, when you're looking at when it has a joint life, it'll always tell you the monthly benefit is per person. So if these were to both go on claim at the same time, we would pay him $7,400, we pay her $7,400. So we'd pay out over $14,000 in benefit to the couple. Now they did choose to buy the lifetime rider, so they have a lifetime benefit, so as long as they need a benefit for long-term care, we're going to pay them $7,400 each. So that total benefits that would be paid out in these examples, so for the husband it would be $444,000, and for the wife it would be $622,000. Substantially different from that 101G policy. And then at the bottom you'll see the cash surrender values. We're at $145,000 in year 5. So real quickly, this is example 2. So we're comparing a tax qualified policy, a 7702B policy, to our asset care policy. And we're going to look at a single life. So we're looking at a single female age 54 with a premium of $100,000 going into the policy. The 7702B policy gives her a $256,000 death benefit. Our policy only gives her $167,000. So again, a lower death benefit. But again, what's the most important? Why are they buying this policy? Are they buying it for the death benefit, or are they buying it for the long-term care benefit? So if you look at the 7702B policy on the left-hand side, they're doing a 2% monthly long-term care benefit. So they're accelerating the death benefit at 2%, and that's going to give her a maximum long-term care payment of $5,100 a month, approximately. And that's going to be available to her for 50 months. So if she were to go on claim for 2 years, she'd get $123,000 out of the policy. If she went on claim for 4 years, she'd get $246,000 out of the policy. So now let's move over to the right-hand side of the screen and look at asset care. So again, we're going to accelerate that death benefit 2%, just like we're doing on the 7702B plan. But our benefit's going to be $66.97. So she's going to get a long-term care benefit, a maximum of $66.97. Now, the difference is her payout on our policy is going to be for a lifetime. So as long as she needs it for long-term care, she's going to get a benefit. So if she were on claim for 2 years, she's going to get $160,000. If she was on claim for 4 years, it's going to be $321,000. And then for 6 years, it's going to be $482,000. So if you're looking at this, if the client is buying it truly for a long-term care protection, asset care would win in this example. And lastly, and this to me is the most evenly matched comparison of the 3. This is comparing a 7702B asset-based long-term care policy versus asset care. So we want to see what that looks like. And I think I see a question, so I want to make sure I haven't missed something really quickly. Let's slide over. Yes, there will be a replay available. I believe what they do, David, at the end is they actually send out at anybody that registered for the call, like you, will receive a link to a replay. So you can definitely get access to the replay. So let's really quickly, because I know we're getting close on time, let's wrap up on this example, because I do think this is the best comparison of the 2. So we're going to look at a joint. And I will tell you, when you're looking at our policies, our sweet spot is definitely the joint life option. Whenever you can add a joint life to the policy, try to do that with our policy. And when I say joint life, when you're talking about asset care, it does not have to be a husband and wife. It has to be 2 people who have insurable interest in one another, and there's no more difference in their age than 25 years. So I've had policies where the lady was widowed and there was nobody she could add to the policy, and we had a conversation and we actually found out she had a niece who was within 25 years of her age. So she was able to add the niece on the policy for a little bit more money, and they both were covered for a lifetime for long-term care. So there's some options out there. I want to make sure you're aware of that. So real quickly, so the 7702B policy, Again, we're going to do $100,000 for the male and $100,000 for the female. We're looking at a male age 67 and a female age 65. I'm looking at the left-hand side of the screen. So they put in $200,000 into these two policies. The guaranteed death benefit, you can see the difference in the guaranteed death benefit. It's not as large as it was on our earlier two examples. So it's $117 for the husband and $140 for the wife. And what you'll see is the monthly maximum long-term care benefit is about $4,900 for the husband and $5,800 for the wife. The duration of the long-term care is 6 years for each. So they have a maximum of 6 years of coverage on this policy. If they were to go on claim in year 6 or have 6 years of coverage, $176,000 would be paid out for the husband and $210,000 would be paid out for the wife. 5 years of coverage, $294,000 for the husband and $351,000 for the wife. And if it's 7 years of coverage, obviously it's going to bottom out. $353,000 for the husband and $421,000 for the wife. And I do see a question, and I'll get it as soon as I finish this example. So if you look at the asset care policy, it's going to be a joint policy. So it's one policy. They're putting $200,000 into one policy to cover both husband and wife. The guaranteed death benefit is $297,000. So we're better on the death benefit than the 7702B plan that's asset-based. So we have a little better death benefit than they do. The monthly maximum long-term care, we beat them both, $59.47. So $5,900 for the husband, $5,900 for the wife. The duration is another item will beat that policy. We can provide a lifetime of coverage for long-term care. So 3 years on claim, the husband will get $214,000, the wife will get $214,000. 5 years on claim, again, it's going to be the same number for this policy because we're going to pay the exact same maximum monthly long-term care benefit for each. So if the husband were to go on claim and be on claim for 5 years, you're looking at $356,000. 7 years, you're looking at just shy of $500,000 in benefits paid out for them while they're on claim. So this one is a really good example, and it really, like I say, is a more apples-to-apples comparison than the earlier two examples that we looked at. All right, let's look at this question really quick. If either spouse goes on claim, are the premiums still due? Jim. So that's a trick question a little bit because it depends on which policy they're purchasing. So the waiver of premium is built into our rider. So if they go on claim while they're on the rider, so what I mean by that is if they use up the entire death benefit portion of the policy, and when they go on claim, let's say the husband, let me take a step back for a second. Let's say the husband, we had a $300,000 death benefit, and the husband and the couple were to go on claim and use up that entire $300,000 death benefit. And then unfortunately he passes away. So all we have left is the rider for the wife. She's got that long-term care benefit, that lifetime benefit for her if she ever needs it for long-term care. Now if she's paying an annual premium into that rider, she's going to have to continue to pay that until she goes on claim. Once she goes on claim, then there would be no premiums due on the policy as long as she's on claim. If she were to come off of claim, then the premium payments would have to start back up again. But as long as she's on claim on the rider portion, their waiver of premium is built into the rider. On our policies, you can add waiver of premium to the base. I would not recommend it. It's price prohibitive, I think. And if you're looking at, depending on what policy you're looking at, if you're looking at one of our multi-pay products, Asset Care 4 would be the example. The premium might, let's say it's $3,000 a year, and if you choose basically a 2-year benefit for the base part of the policy, you're only having $2,000 a year premium, so a total of $4,000 a year, $4,000 for the life of the policy before you're going to move over into the rider portion. I can give you more information, but I wouldn't recommend putting the waiver on the base, but it's definitely built into the rider. So let's quickly, I think we're almost done. I know we're right at 2 minutes. Just want to wrap up, and the main reason we wanted to provide this presentation was just to give you some comparison information, just some education around how a 101G plan works versus how a 7702B plan works, just so you have the information so you can educate your clients and make sure they're making the correct decision when they're looking at these types of policies. Because as I said, I've run into agents out there who didn't realize they were selling a 101G plan. They thought it was they thought it was a tax-qualified long-term care rider. So just some information. It's just vital that we know what type of product we're looking at and gives you some guidance, because you can call the carrier. Call the carrier when you're looking at a policy if you're not sure, to find out what type of plan it is. Ask them what that monthly benefit's going to be. If they don't know, then it's a chronic illness rider. Find out if they can tell you, anything about it. Can they market it as long-term care? If they're not marketing it as long-term care, then more than likely, odds are it's a chronic illness rider. So with that, actually, I'm sorry, I have finished. If there's any more questions, I'm going to jump over here to see, because I think we're right at time. But I'll be glad to answer any questions if anybody has any more questions. I want to make sure I didn't miss anybody. I'll tell you what, okay. Well, I really appreciate you guys taking the time. Okay, wait a minute. I do see a couple questions I might have missed, and I want to make sure I answered it. We're good. I think we're good. I appreciate that, and I'll ask the team to actually include that tax guide when they send out the follow-ups. If there's a way I could add the underwriting guide, I'll do that as well. But we really appreciate you taking the time today to learn more about 7702B plans and 101G. Hope you have a wonderful day and a great weekend. Thank you.